That's quite amazing that risk premiums that means risk stocks are richer than they were before COVID by a couple of hundred S&P points, roughly. The same applies to where equities were at the end of this last year of 2021. In December of 2021, equities were actually cheaper than they are today by a couple of hundred S&P points. And since then, we've had nothing but tightening and quantitative, both raising of rates and quantitative tightening. So that would indicate, just from a risk premium standpoint, which by and large is the result of monetary tightness and a little bit in volatility. And volatilities are about the same as they were before then. That would indicate that conditions have actually eased. Now that's possible if the economy is strong, because it's all easing and tightening of financial conditions is all relative to the strength of the economy. And the economy's been strong. So it makes some sense that financial conditions have eased along with a strong economy. But there's been all these forces that the Fed has thrown at the market to be offsetting that type of strength. And yet equities are richer than they were a year ago at 4,800. Part of that is because there has been a sort of, and when you do something relative to bonds, well, bonds have a risk premium too. And I don't want to spin out of control on this, but it's possible that bonds are so unattractive to people, long-term bonds, because of their once in multiple centuries worst performance in history, that bonds are actually for sale relative to equities. And that's part of the reason why equities look rich, because bonds are just so cheap because no one wants them. And that reflects in their relative risk premiums. But I think it's much more simple than that. You look at the amount of tightening that's been done and the impact it's had on the economy. And I think we're just in a situation where equities are just on the rich side. And, if gun to my head, what would be my favorite trade? It would be short equities. I don't happen to have that trade on, but that would be, I'm short everything, which is different than being just short equities. Yeah. I'm short equities, but I'm short bonds and stocks and all and gold and all those other things, because I don't want to. Equities will work for sure as a short in a recession, and they won't work in a soft landing or a higher for longer. But so I don't want to make that bet, because I think everyone's making that bet at this stage right now, to be honest. I think there's, as we've said, the recession is priced into many markets, not equity markets per se, but priced into many markets. And so I think it's fairly well expected. So now the question is, do you want to make that bet? And I just don't know. So I'm not making that a pure directional bet on equities. The trade to have on, if you were really thinking a recession, is long bond, short equities. If we're headed toward a recession, we're going to have a much larger drawdown in earnings than has happened to date. And if we're not, they're going to beat. And this is a complicated time in the U.S. It's just not clear to me that, and people have very strong opinions on whether we're heading to a recession or heading to a longer term inflationary period, for very good reasons. And it's hard to know. And so I'm just choosing not to.
Right.
Great convergence is bonds have underperformed massively equities, and that some of that underperformance will result in a bounce, an outperformance, a convergence between those two paths. But that's the US, and I've described that situation. I wrote a chart that describes two dimensions. One is, do assets outperform cash or not? And the other dimension is, do bonds outperform equities? And I plotted, using the models I use to evaluate this, where I think we are in the world. And it's consistent with, I think, what's happening globally post-COVID. And the U.S. led on the way in, both with stimulus and response and fiscal and monetary easing and, a full-blown response. And now we're at the inflationary, we may be at nearing the inflationary peak of that experience. China, on the other hand, and to a lesser extent, Japan, is really at the front end of that. So, if you just sort of look at your calendar and say, where is China? And I would say China's in this, in Q3 of 2021. And Q3 of 2021 resulted in, a fairly big equity outperformance relative to bonds. And I think that's, what we're going to see in Asia. I've recently bought for Damp Spring some China equity exposure. That's a complicated trade given the rule of law issues, but it does express this view that cash is trash in China, assets are good, and equities in particular are best. And when you go to Europe, they are, I would think, more like Q1 of 2022 in terms of their COVID response. Now they have the war overhanging and the energy issues overhanging, so they're, it's a little different, but timing is different. But they are in the beginnings of their tightening phase. They're not restrictive. And so at the time in November, I suggested you want to be short assets because they're at the beginning of their tightening phase. And we know what 2022 did to assets in the US when we started our tightening phase. But you do want to be long stocks relative to bonds. And so, if you look at DAX and European stocks in general relative to bonds, it's been a massive win to be long stocks and short bonds in Europe. And I think that trade probably has some legs. We'll see. It'll dip and fade like anything else. But, the fundamentals are, we're at the beginning of our tightening phase. That's very bad for bonds, but we're still stimulative. We're still not restrictive. And so that tends to be good for equities. So, as I run around the globe, cash is trash in China, cash is king in the US and Europe, and equities are best in China, and equities are best in Europe, and equities are probably worst in the US. I would say that it's, the transparency around the government bond market in China and the ability for anyone to access those markets makes me suspicious about taking much direction from, and for that matter, investing in China. So, it's not for the faint of heart, and I would never devote a significant not never. Today, I wouldn't devote a significant part of my portfolio to a Chinese investment of any sort, but I think the fundamentals are driving it, which is there will be a natural growth impulse, potentially stimulated by fiscal policy, that will result in, the same sort of dynamic that drove equities higher in the US when we came out of COVID. And we'll see how it impacts inflation. I think there's many schools of thought on that in terms of, which includes things like understanding the supply side. There's a bull case for oil, which I don't happen to share, for China reopening, that ignores their storage. That's important. You have to look at both the supply and the demand. But from the demand side, it seems like there would be excess demand for goods and services domestically, and at some level an easing of supply as more production is able to be done by the Chinese as they come back, which is, globally deflationary. But, I think the goods and services demand, the commodities demand, et cetera, is probably, I added up to slightly inflationary globally, but certainly good for stocks locally.